Howdy out there, folks. It's your skipper here to welcome and present another episode of Macro Bundle Live Q&A. I'm joined with my friend, founder and managing partner, Jake Weinig of Iceberg Capital. How you doing today, Jake?
Thanks so much for having me. It's great to be here.
Yeah, man. Looking good. Looking tan, man. You down in Bermuda, the Caymans? What's going on now?
We are headquartered down in the Bahamas.
Bahamas,
so
absolutely.
you know the office here has some perks, mainly the sun.
Couple perks, man. Yeah, a little bit different than New York, but so anyway, man. So tell the folks a little bit of background about yourself. You've had a very storied career in Wall Street. You're in the crypto space now, but you're a native TradFi person. So give us a little background on who Jake Weinig is.
Yes, I do love the new term TradFi, which
I feel like a millennial.
I spent my career in the equity volatility world, which is most people would not have traditionally called TradFi, but certainly is versus crypto now.
Exactly.
Yeah, so I right out of college, I spent just under 10 years working at Goldman Sachs. I worked with a handful of institutional investors for the first part of my career within the equity derivative world. Later on at Goldman, I was both on the sales and trading desk for equity volatility, where I worked with, again, institutional investors, pension funds, endowments, foundations, as well as a handful of volatility funds. In 2013, I actually transitioned. One of my prior clients had seeded us with $50 million to start an equity volatility fund ourselves. We left and started Malachite Capital in 2014, grew to about $1 billion under management before shutting that down in 2020 when I shifted over to crypto. And before we get into Iceberg, I'll just tell you a little bit about why I made that transition and why took us kind of so long to really move into crypto. I like to say I was a very fortunate owner, not necessarily trader, but owner of crypto for about the last 7 years now.
Mm-hmm.
Historically speaking, however, it was nothing more than a hobby for me. And very specifically, I really never viewed it as a business. Yeah. And I'll really explain why. Is not only was it a amount of risk that was something that I was willing to take, but not something that I was willing to extend to investors. But more importantly, it was something that was very clear to me that if and when regulation were to come, that it could theoretically be a quote unquote crypto killer.
Mm-hmm.
And what really changed, and this changed for me in 2020, and it's not a too big to fail type story. It's not. It's really just the use of and the use case for cryptocurrencies, for blockchain technology, maybe even more importantly, became so clear that this was going to be the future, that both institutional investment in the space, obviously we've seen that rising dramatically and is very important to what we're doing. But more importantly, the regulatory tune really, really changed to the point where regulation was no longer even potentially a crypto killer, but really the opposite, something that's going to be required in order to get crypto to the next level. And really, I believe at this point, a tailwind to getting crypto to the next level. And, we talk a lot about the kind of similarities in the digital asset world today versus the internet in the late 90s.
Oh yeah.
You know what I mean? I think it was Janet Reno said, the internet is only for fraudsters and for criminals and fraudsters or something like that.
That's a very famous last quote.
But that was really the analogy. And, I compare it actually very similarly. And actually, the events just of the last week with some of the Terra ecosystem really even make this case even more. I've been comparing the crypto markets today, the digital asset markets today, to the tech markets in the late 90s. And if you think about that, and you think about what a bubble that created, and ultimately leading up to the crash in 2001, you can think about it and say, okay, well, there's nothing good that can come out of this. And I would actually argue quite the opposite. I mean, if we fast forward 21 years now after the crash, the tech crash, the largest companies in the world today, they're all technology companies.
Oh yeah.
Right. So not all bad obviously came out of it. Now, was there a lot of pain and a lot of destruction? for sure. And if we've just seen, again, we've seen some of the events last week, the 5th largest crypto by market cap lost 99% in 3 days.
Wow.
Right? Clearly, if events like that can happen, there are bubble type appearances here that, something that does need to be addressed. That being said, I have full confidence that we fast forward not 20 years, but 5-10 years from now, you'll see some of the largest companies, technologies, assets in the world. My belief will be in the blockchain, in the digital asset community.
Absolutely, man. I agree with that as well. And so when we, before we even get into the sort of Terra Luna debacle and all that kind of stuff, walk me through like what it is that you actually do at Iceberg Capital. Like, what is your strategy to manage risk and generate alpha for clients?
Yeah, for sure. So we actually run 2 funds right now. We're actually in the process of launching a 3rd one. But our flagship fund, we call the Iceberg Crypto Opportunities Master Fund, is very simply that. We look at long-term capital appreciation opportunities in the crypto space where we think the risk reward can really outperform. And we're looking to both outperform both more passive crypto benchmarks, if there is something, as one for, within the crypto space, but also kind of really any sort of active management. And we do this through both a combination of, and I'll use some crypto words, but then I'll explain it, both CeFi and DeFi exposures. CeFi is more of a centralized exchange program versus decentralized. You can think about CeFi as things that are trading on Coinbase or a Gemini or an exchange like that, versus more DeFi projects that tend to be kind of more standalone projects, completely decentralized from the rest of the world. We also have a portion of our assets that we do in both direct investments and venture cap. And so, we've been around for just under a year right now, have had some nice outperformance versus many of the benchmark coins, and a lot of the more kind of commingled strategies that are out there.
Gotcha. I remember you were this must have been a year and a half ago now, when you were talking about the idea of Iceberg Capital, and were you able to transfer your sort of kind of vol arbitrage skill set to derivatives and crypto, or is it kind of too wild?
Well, okay. It is certainly the Wild West and the option, the volatility markets of crypto. Yeah. I've spent my career looking for inefficiencies in volatility markets and derivative markets. I should mention our second fund is our Bitcoin income fund, where I wouldn't call it vol arb, but we do utilize some of the option markets and the inefficiencies there to generate some alpha, generate yield for our investors as well.
Gotcha. Yep. That makes sense. Yeah. So shifting gears a little bit, I'd love to hear an insider's rundown on what happened sort of last couple of weeks with the whole Terra Luna situation. Kind of any thoughts on potential spillover, where we are in the whole process, the whole kind of unwinding process of a lot of the leverage we've seen in the crypto asset ecosystem.
Well, okay, yeah. So there are two very important points there, and let me touch the second one first. When you just talk about leverage, and one of the questions I think you asked me in the prep, and I guess we'll get to it right in advance, is what are some of the risk management things that you talk. And this is not just true in the digital asset markets, but it's particularly true here, partially because of the decentralization and the lack of oversight, the lack of regulation, but also partially because of the investor behavior and the type of investors that digital asset markets have encouraged. But we've seen just an absorbent amount of leverage allowed to investors in the crypto markets. That is always a red flag and always going to end in heartbreak and disaster. And kind of every bad story that we've heard. Well, there are a few different topics, but a lot of the ill intent stories of I didn't understand what I was exposed to are people that looked at something and said, "Oh, I can get 50-to-1 leverage, 100-to-1 leverage on my money." Of course, it's either I'm going to make all the money in the world or lose this money. Almost always ends with them losing it. And so just staying away from leverage in these markets. These are already exceedingly risky, fast move markets. You do not need leverage here in order to make a lot of money.
Totally.
So start with that. But leverage is really the story that we see in a lot of these cases. The most recent catastrophe is, as you mentioned, what happened here with the Terra ecosystem. So Terra was founded by a guy named Do Kwon. Do Kwon historically had created stable coins and had created this Terra ecosystem to create algorithmic-based stable coins. So essentially what a stable coin is it's a way to get your assets onto blockchain. So within the digital asset world, something that can be transferred and held within the crypto markets.
Yep.
But reducing the volatility of the risky assets associated with things like Bitcoin, Ether, and so on and so forth by having a stable peg to the dollar. So Terra created their Terra US dollar, which was a UST was the ticker. And essentially the simplistic way of the way it worked is it had some reserve backed in dollars, in Luna token, and in Bitcoin. And when there was enough demand for UST that it went above the dollar peg, it would sell some to buy Luna and then burn the Luna token, essentially creating demand for Luna, making the price of Luna go up, and then burning it. So it's essentially removing any supply so they could never sell it. Burning is a crypto term. Essentially, it means they transfer it into a wallet where the wallet is never allowed to sell.
Gotcha.
So essentially, there's no way that those tokens could ever then be used to create any supply.
Gotcha.
Conversely, as there was selling pressure, if UST went down, the Terra algorithm would then use some of its reserves to buy back UST and reestablish the peg.
And I assume its reserves are Bitcoin, right?
Its reserves were in Bitcoin, in Luna, in any number of assets. Part of the issue, and you'll read a lot of issues with stable coins, is even the Tether, which is pretty much the gold standard for stable coins here. Not everyone's 100% sure. There aren't filings and regulation filings as to what is behind it. Now you can see certain wallets. You have a sense as to some of the things that are behind it, but really at some levels you're taking their word for what they have behind it, unfortunately, and that's part of the cloud over the crypto world. Again, a lot of things that Janet Yellen was talking about earlier this week, or last week, I should say. Crypto markets don't close. The weeks all kind of blend together.
I know, right?
Last week, really, targeting stablecoins and the risk behind it, and saying, particularly for investors that are, thinking their money is tied to pegs, we need to have regulations as to ways to, what has to be behind us and how we can reestablish that.
Gotcha. Absolutely. So just give us your general thoughts then, kind of where we are in this broader market cycle within crypto. Obviously, I have thoughts on the macro cycle broadly, but is there anything sort of within the crypto ecosystem that might be a leading indicator for the broader macro cycle or a lagging indicator?
What's interesting is prior to the events with Terra Luna last week, I had been, we've seen declines in Bitcoin, declines in Ether, and a lot of the alternative coins as well. I had been saying to all my investors that not one of these events is a fundamental event that actually changes the long-term worth or the long-term value of the digital asset markets. Yeah. And I am a firm believer that blockchain technology, in not just as a financial instrument, but really in many, many, many number of different industries, is really the way that the future is going for a lot of different industries out there. About technology, supply chain, any number of things. Places are going to utilize social media. People are real estate. People are going to utilize blockchain technology. I believe that this is a fundamental, not change to the future of this, but a major delay and a major hit on the confidence that institutional investment are going to have in digital assets, because this is actually something very unique towards the DeFi markets. And really, again, it was caused by, I think we mentioned this in our prep, but I believe, and again, it's hindsight is very much 2020. But a lot of these DeFi protocols, the way that they get noticed is they offer, or some of their partners or whomever they can offer, high yield on investors that are quote unquote what's called are agreed to stake their coin. And essentially what staking means is essentially you give up your liquidity. You agree that you're going to be a longer term holder. And when I say longer term holder, I mean longer than buying and selling it today.
Mm-hmm.
And essentially, as long as you're staking it, you would earn some yield. Now that yield is paid in kind, right? So essentially what it means is essentially if I'm staking my UST, I'm not earning, and I'm earning a 20% yield. I'm not earning for every $100 of UST I have or 100 UST tokens I have. I'm not earning 20 US dollars.
Gotcha.
I'm earning 20 UST tokens per year.
Gotcha. And so where does the yield come from? Is it incremental supply from the token?
That's correct.
Gotcha. Gotcha.
And so, a lot of these protocols have the ability to pay out very large yields in kind, partially because they're gaining more users or gaining assets or whatever the case may be. But again, remember they're earning it in kind, not necessarily out of some sort of reserve or treasury.
Gotcha.
And so that can bring a whole slew of potential investors. And the problem is when you have an asset where an overwhelming majority of the users are leveraging are buying levered exposure to earn yield, then the second that there's a red flag, they all hit the exit at the same time.
Wait a minute. So can I pause real quick? Because it sounds, I want to make sure I really understand this before you continue. It sounds like, let's use Monopoly as an example. You buy a property and you earn the yield in Monopoly money from buying the property. It's illiquid, technically speaking, until you have a fire sale later on in the game.
Well, it's not
sort of similar.
It's not a liquid. You can, those rewards can be transferred. In any normal environment when there's not a fire sale.
Yep.
At any moment, those rewards can be taken. They can be transferred to your wallet, right? From your wallet, you can either go to one of the centralized exchanges or to any number of the DeFi exchanges.
It doesn't trap you in the yield doesn't stay trapped. Your stake just stays trapped. Your principal.
The more that you have staked, the more. So like if I stake for one day, and I'm using broad numbers here. Instead of having 100 USD, I'll have 100.2 or whatever it is. So I'm earning more and more money the next day, so most people will end up keeping their money there. But gotcha. You have the ability to redeem or to take your exposure out at will.
Oh, gotcha. So it's not completely illiquid. You just want if people are incentivized to keep their money staked. Gotcha.
That's correct.
That makes sense. Okay, sorry to interrupt.
No, and I think basically what I was saying is but and then whenever you have these lever investors and you start to see red flags, the yields go down, the total return that I'm getting falls below a certain amount, then I'm gonna hit the exit exactly at the same time, and essentially while the algorithm works and 99.9% of situations, obviously when everyone hits the exit at the same time, it created just an unreasonable amount of supply that just overwhelmed the algorithm, overwhelmed the amount of reserves. And, I think they had something like 80,000 Bitcoin, which is a couple $2 billion of Bitcoin in reserves, not to mention Luna and other things. I think after 3 days, they had sold all but 313 of their Bitcoin exposure. I mean, you can see how much money they had to put into trying to maintain their peg. And unfortunately, it was not enough to overcome the supply, and it broke the market.
Yeah, I mean, it's pretty stereotypical of most bank runs, right? I mean, it's a new asset, new ecosystem, but it's the same old dynamics where when people hit the exits, it's gone. That's
exactly. And once the confidence was gone, then they were never going to get it back. Even if they had the assets to reestablish the peg, it seemed very clear after day 2 or 3 that the confidence was just completely shot. Particularly in this founder, who, I mean, if there's some interviews of him as recently as 9 days before this happened, where he's laughing at failed projects. He's saying it's funny to watch, these people lose all their money, calling people poor for not investing in Luna. He's quite a character out there. So.
Yeah, well, it seems like the greed and the hubris that is very indicative of a TradFi, CFI. Is filled over into DeFi as well. So give me some sense and thoughts and some questions in the queue, kind of summarizing where we like in the broader capital market cycle for crypto, you raising capital from investors, venture capital, et cetera. Has that kind of come to an end, or are we still kind of, chugging along?
No, in fact, I think it's in the very early stages. I mean, it remains to be seen. Let's put it this way. 2 weeks ago, basically any project out there, investors were throwing money at it. And
Gotcha.
Partially why I relate it so much to, the tech bubble. You think about the, .com bubble, anything that was .com didn't have to have any sort of business. Here's a blank check, and we don't care. We actually prefer if you don't have earnings. Right?
Yeah, don't make money, please. Just
just spend money. So we're kind of very similar. I mean, especially on the VC side, these protocols and projects are raising money at lightning speed. So that remains to be seen as to how recent events are going to change that. I think there certainly are going to be a little bit more scrutiny and oversight, and second thoughts about blank checks right now. But we're certainly in the very early stages of these projects. And look, as governments, and not just the U.S. government, but as governments get more involved, honestly, that can only be a good thing. Obviously, there are going to be some regulations that I and other crypto enthusiasts and players don't love and don't agree with, but long term regulation and oversight is what is going to enable this to really become what we in the industry all know it will be in a handful of years.
Totally. I mean, imagine if they never regulated the internet, the kind of stuff you'd be seeing on the internet all the time. People stealing your ID and credit card information constantly.
We would see Darius Dale all over. Without regulation. Yeah.
Exactly. So let's shift gears to some best ideas, man. Like kind of what's hot on your list, what's not hot on your list. Talk to me about some specific tokens.
Yeah, well, look, for those that have been on the sideline over the last couple of years, particularly in the last year, I guess this is certainly. I mean, I for the last week I've gotten this question every single day: Is this the bottom? Is this the bottom? Is now the time to buy? And look, what I'll say is this: we certainly could have more pain. Recently, the correlation to equity markets and risk assets in general has picked up dramatically, significantly more than we've seen over the last number of years, particularly towards the tech sector and the NASDAQ in particular. And I guess you're the economist, Darius, but from a market standpoint, I could certainly see some more pain to come, particularly on the equity side. So I'm not going to necessarily sit here and call a bottom yet, but I do think that there are a number of really interesting buying opportunities. That being said, long term, I have no doubt that the digital asset markets, that blockchain technology is our future. And so for those that are not invested, I honestly, having some exposure to just the two blue chips, which are Bitcoin and Ethereum, is an absolute must in your portfolio, whether it's 1%, 2%, 5 to 10% of your portfolio. It really would be, there is true potential that many countries start to take over Bitcoin as reserve currencies. You've already seen El Salvador moving in that realm. This is not just a U.S. thing. In particular, it's really, it can survive without the U.S., although it won't have to. But we're seeing institutions get involved again. It may slow in the near months. Out of control hyperinflation and kind of unexpected numbers have created more volatility. But really, so far, a lot of that is really just what it is. It's volatility, and we've seen 70-80% corrections, unfortunately, in this asset before, and I believe we will again. But that also comes with higher highs, pretty much every single time.
Absolutely. And so just following up, like one thing I heard you did not say was, hey, go make sure you have a bunch of exposure to, this coin or that coin or this coin or that coin. Kind of walk me through kind of what your thoughts are on all the, kind of other coins outside of the
block. So I'm happy to go through a handful of names. Maybe that's a follow up with some of your investors or some of your listeners.
Yeah, absolutely.
That we think are kind of real world businesses and real world, things that can outperform. To be honest, just where we are in this, in this current drawdown, I don't believe that all the pain has necessarily played out in a lot of the kind of alternatives. And I think at least right now, especially for those who are not yet invested, kind of starting with the Bitcoin, Ethereum, probably the right way. That being said, that there are a handful of alternatives out there that I firmly believe have potential real world use, and over the next, again, 6 months to 12 to 60 months, will be major outperformers. And frankly, that's what my team and I spend really all day on every day is, looking at these companies, talking to founders, DMing on Twitter, and which is basically the way that everyone.
It's bigger than FinTwit. Crypto Twitter is bigger.
Yeah, crypto Twitter is the way to speak to people, right?
Yeah.
Just talking to people all day long about kind of what they're thinking, what they're looking at, and we're always looking at good management teams. And so there are a handful of projects out there that that I've been a big supporter of, and that we still have a lot of faith in going forward.
That sounds great. And so, anyone, shoot me an email if you guys want to get into contact with Jake. We'll help you. We'll connect you with his team. We'll go from there. But 2 charts I wanted to show before we wrap up, Colin, if you don't mind putting up the chart deck. So you mentioned we have not yet seen all the pain that we're likely to see, and I wholeheartedly agree with you. This chart here, just the red line, shows your former alma mater, Goldman Sachs Financial Conditions Index. That's at 99.3 when I updated the chart yesterday. And then we're at 5.7% of the black line in terms of the S&P 500's next 12 months earnings yield. And so as a proxy for valuation. And so one thing I look at is, hey, where are we where are we in the context of tightening financial conditions that, have we tightened them enough to suggest that, hey, okay, we're on alert for a Powell pivot? When he did that pivot in 2018, we're at significantly higher levels and actual outright tight levels from a financial conditions and earnings yield standpoint. So it tells you that we definitely have some pain to go. We've seen some very, pretty sharp tightening off the lows, but that was just to get us back to what is, comfortably a long-term mean. It's very likely that we go above the long-term mean if you talk about slowing from a growth perspective to something that's, comfortably below potential and maybe even potentially recessionary. So I would 100% agree with you that there is more pain to come in risk assets. And then lastly, another way to look at this is kind of looking at it through the lens of the growth cycle. So that was kind of looking at it through the lens of the liquidity cycle. Through the lens of the growth cycle, this is the blue line is the OECD Composite Leading Index time series for the world economy. The red line is the S&P 500 high beta index as a ratio to the low beta index. And what you've seen is that we've had, kind of 3 non-recessionary downturns, or this one's locked down, so I'll ignore that, but 3 non-recessionary downturns in the post-crisis aggressive G5 central bank expansion era. And each of those, non-recessionary downturns, we saw a, kind of like 35 to 40-ish% decline in the high beta, low beta ratio relative to 35 to 40% decline in the high beta, low beta ratio. We saw a 66% decline in the GFC peak to trough. Right now, we're only tracking at around 25% down. So it's telling you that if this is a non-recessionary slowdown, we got a decent amount of pain ahead of us just to get to fully pricing in that growth slowdown. And if this is a recessionary slowdown, I don't think it's going to look like the GFC, but it could very much look like the bursting of the dot-com bubble. And you're talking about 40, 50%, 60% decline in the high beta, low beta ratio. So we haven't seen anything yet, in our opinion, from that perspective. So cool. That's it, man. So
wait for us to scare investors today, huh?
No. Well, I want to scare people into making the right decisions. I don't want to scare people into making dumb decisions. It's just, hey, I spend a decent amount of probably hour and a half a day on Twitter answering questions from subscribers and potential new subscribers. And it's, when do I buy the dip? Is it over? I don't have anybody telling me, is Bitcoin going to 15,000? I don't think it is going to 15,000. I think the world will back the truck up at around 20,000, but who knows? Well,
I mean, yes. So, and just, I guess maybe I'll leave you on that note is what I will say about it. I don't believe that we've necessarily seen the bottom. I don't know, but that's my belief. But the risk reward is certainly, I think in the right level. Could we see 20,000? Certainly, we possibly could. We could even see below that. I don't think that. I'm not quite as bearish, but we certainly could see that. On the flip side, though, this is an asset that I do believe over the next couple of years is certainly a 6-figure asset, 100,000 plus. And over the longer term, I still believe 500,000 to $1 million is probably my longer term price target.
Oh, you heard it here first, folks. 500,000 to $1 million. So definitely get in contact with me if you want to get in touch with Jake, and we'll go from there. Catch you back here next week, everyone. Thank you.